Thank you. I'm Joe Evans, and the tall, good-looking guy here is Bill, Bill
Aw,
Sarb.
thank you.
We're delighted to be here. Hope you're enjoying the conference so far. One thing before we get started, I just want to point out that we're the messengers. We didn't write the rules. We just help you all comply with them, and hopefully today we'll all walk away with some good information. So without any further ado, Bill, you want to get started?
Sure. My first comment is I hope everyone enjoyed their lunch. This is going to be a relatively long discussion about all the new exciting changes that the GASB has brought on our world. Just a quick agenda. We've already done our intros, but the first part of our presentation today is really going to be just to talk about GASB Statement number 67 and GASB Statement number 68, which are the reasons for a lot of changes and a lot more scrutiny over pension data, and the reason you guys are being contacted by us and INPERS, being the Indiana Public Retirement System. And we're going to go through that overview. It's going to be a little longer than the agenda states, but hopefully we'll stay within the time frame, and we'll make sure everybody gets the break. And then when we come back from the break, we're going to talk about more of the specifics when we as the auditors for the Indiana Retirement System come to the counties to perform the payroll and census data audits. So we kind of went over this already. Joe is my boss, so I'm sure he'll be rating my performance today.
I already gave him a compliment. He's the good-looking guy.
We'll kind of gloss over that and just go right into our presentation. All right, so the big changes that are brought on by the GASB was back in June 2012, they issued two new public accounting or GASB standards, which really significantly impact the financial reporting for the pension plans as well as the employers who are members of those plans. GASB Statement number 67 is specific to financial reporting for the pension plan itself. So in this case, the Indiana Public Retirement System implemented the changes of GASB Statement number 67 for their June 30, 2014 financial statements. So last year was really the first year that some of this stuff got started. And now moving forward, GASB Statement number 68 is specific to the employers of the plans, which would be all the counties and municipalities throughout the state. This will have a significant impact on financial statements who follow GAAP. What this is doing is projecting and discounting the pension amounts, and there are additional disclosures that are going to be required for financial statements related to the pension amounts.
Just maybe as a matter of background, for years, the net pension liability, or the amount that had to be set aside to satisfy all of the pension amounts, was not a number that was ever reported in anyone's financial statements. So what would happen is the governing body would get together with the actuaries, and they would come up with an estimate of what this liability is and determine the funding mechanism for that liability, what needed to be contributed during the period. But the liability was never reported by anyone, the total amount outstanding. And so what happened was many governments ignored that information and ignored that liability. Many elected officials ignored that liability. So they looked at what was important to them was what had to be contributed for the current year. That's what they focused on, but they didn't focus on the fact that there's millions, in some cases even billions of dollars out there outstanding that had to be dealt with in the future somehow. So the GASB, the standard setting body for all governments here in the U.S., thought that this was an important item that needed to be reflected in the financial statements for the organizations that are responsible for satisfying that liability. So in the case of the Indiana Public Employees Retirement System, they determine what the liability is, but then that liability gets allocated to the employers based upon their proportionate share. So if you're a single employer government, for instance, these rules would apply as well, and you'll have to pick up that liability. So that's just a little bit of background as to why the statement came about, and hopefully I know in Illinois it's generated all kinds of discussion. One of the things I heard on the radio this morning was the Chicago pension funds are the worst funded in the nation. Of course, Chicago's bond rating is now the worst in the nation as well. So they have a lot of work to do there. But anyway, as a matter of background, we're hoping that this gets elected officials to better understand what the issues are and that they're dealt with more proactively rather than after the fact.
One thing I'd like to add to that, Joe, we are both from Illinois and have a lot of experience with the Illinois plans. Last year we came in and we got a lot of experience now with the Indiana plans. One significant difference is the funded status here is significantly higher than the funded status in the neighboring state, and it's a little less of a impact here. Not so much impact, but not as big of a number that these employers are going to have to pick up, or the state might have to pick up for the employers, and not quite as much uproar, but definitely it sounds like you guys are a little more conservative and kind of doing things the right way. All right, so within the INPERS financial statements from last year, there were several changes to the reporting requirements. A lot of this stuff is related to some of the changes that the employers will need to implement going forward. Specifically, the plan now needs to disclose details on the board and the makeup of the board, as well as relating to investments. They need to disclose the money-weighted rate of return for the year. That rate of return it brings into account cash flows a little bit more to give you a little bit more understanding of the actual rate of return that they received during the year, and then also the long-term expected rate of return that the plan anticipates being able to get based on their investment portfolio. But the biggest and most significant issue, and the issue that will then impact all of the employers, is, and some of this is just changing terminology, the actuaries of INPERS, specifically the PERF plan, which I know a lot of the counties here in Indiana are members of, they are measuring the total pension liability for all members that are a part of that plan. That liability is measured using a variety of actuarial assumptions, which are reviewed by us as well as actuaries to determine their reasonableness, and that liability is measured and compared against the actual market value of the plan's net position, which takes into account all the investments they hold, etc. It's just a quick math formula to get to the net pension liability, which is going to be the total minus the position of the plan at a point in time, and that net pension liability is what needs to be allocated to the employers in a cost-sharing plan, as well as recorded by the employers moving forward.
Just a comment here, I think, before we move on. Prior to GASB Statement 67, there were a number of acceptable actuarial methods that were used to determine what that liability is. And there was no real consistency among various governments as to which methodology they wanted to use. And, some methodologies produced higher liabilities, some less. And obviously it impacted the cost and the contribution rates that had to be made. Under the new standard, there's only one method that's being allowed to be used, and that's the entry age normal actuarial method, and that way it brings more consistency to all of the various actuarial valuations. Other methods can still be used for funding purposes, but for purposes of calculating this NPL, as we call it now, the net pension liability, we all have to use the same actuarial method.
That is true. I think one of the main reasons for that, based on my understanding of the GASB, is it was really difficult to look at one state versus another and compare, okay, how is the pension plan funding? Are we funded at an acceptable level? If you looked at different states throughout the nation, since they were using different measurements and different ways to measure it, the comparability was kind of almost impossible. But so this is kind of a way for financial reporting purposes for everyone to kind of see exactly where we are today. Another significant change relating to that is, in the past, they used to allow an actuarial value of assets, which would be an actuarial calculation to kind of smooth out assets, to kind of not take into account significant shifts in investment rates of return that could occur in a small period. That has been taken out. It's now measured against the market value of the plan at a point in time, which personally I think makes a lot more sense. No one really understood exactly what the actuarial value of assets were. It kind of is like, oh, well, we have this today, but the actuaries say it's really only this. It didn't really make a ton of sense, so that's been changed as well.
Well, and I think everyone understands market value. You know,
Yes.
that's a very easy concept to understand. You look in the Wall Street Journal, you see what the value is of, a traded security, whereas the actuarial value was kind of a nebulous number that no one really understood. So
Yes.
it helped clarify it as well.
I know I didn't understand it. All right, another significant item relating to the measurement is a concept known as the discount rate. The discount rate it could be a single rate or blended rate depending on the funded status of each pension plan. So when measuring the liability, there needs to be a set final discount rate used to discount the benefits back to actually calculate the liability. In the past, that rate was generally just the long-term expected rate of return used by the plan. However, that has now been changed. With GASB 67, this measurement will be more specific to a projection based on today, who's members of the plan. Based on today, we're going to project, the actuary is going to predict how long people are going to live, how long they're going to have to pay benefits, and how long the contributions are going to be coming in to cover those benefits. And at any point in time over the next 100 or so years, if we run out of money, if the fiduciary net position of the plan becomes zero, then at that point, you can no longer get, if you don't have any assets to invest, then using the long-term expected rate of return really isn't reasonable. So the GASB has come out and stated that to be more conservative, at that point you would switch to a shorter-term municipal rate, which would have an impact on the discount rate, which one of the new disclosures will show has a significant impact on the actual net pension liability calculation.
Let's move to the next slide because it talks a little bit about this, the discount rate calculation. And maybe before getting into the details of this, the discount rate has such a significant impact on the actuarial liability. When the GASB passed the new standard, they wanted us to apply more science to the discount rate. And so not only is it a projection based upon the types of investments and the investment mix that an organization has, but as Bill mentioned, we have to do this projection now where we project out the payments and whether or not there's going to be enough money available to continue to invest at the same type of investment mix that we have today. And what the standard says is if you don't have enough money available to invest at that higher rate, you have to use a discounted rate, which is the long-term bond rate, which in most cases is going to be significantly lower than what the planned discount rate is. And so this slide really talks a little bit about the calculation that needs to be done. And I don't know that we need to get into too much detail about it, but essentially it's a projection of the cash flows for the next, however long it takes to satisfy the liabilities of the existing pension people today. Couple other comments about the discount rate. We have a situation we're involved with right now where a pension board received information from their actuary, information from their investment consultant, and the information they received suggested a 7% discount rate should be used for this particular plan. And the board wasn't really happy with the results, and they had 7.75% and as much as 8% in recent years, and so they felt it really wasn't appropriate to go down that low, so they went down to 7.5% instead of the 7 that was recommended by the actuary and the investment consultant. Well, that 0.5 percentage point difference results in a tremendous difference in the amount of unfunded liability that remains at the end of the day. And so what we're going to talk about later is, GASB 68 is going to say that unfunded liability has to be allocated to the various employers. Well, if that unfunded liability is materially misstated at the plan level, we've got a problem already, even before we get to allocating that to the various employers. So anybody that maybe has their own plan, single employer plan, or I know the people that participate in INPERS, it's a different story because that decision is made at the plan level. But anyone that participates in a plan, it's really important now to look at this discount rate, look at the recommendations of the professionals, and if you're going to deviate from that, you better have some pretty good reasons for it. So now, as the auditors, we come along 6-8 months later and say, look, 7.5% isn't going to fly. This doesn't work. And in prior years, we were never as vocal about it because the number didn't go anywhere. It just sat in the footnotes of somebody's report. But now that it's going to end up in the financial statements booked as a liability, we got to apply more science. We got to make sure we're using the right information. So long story short, we ended up having to redo the actuarial valuation, and of course that's going to delay the issuance of those statements.
So as Joe stated, the discount rate becomes very significant from our perspective, as it's something that our audit is really focusing on, especially this first year, with little experience in looking at the projections because they were never done before. So when they're calculating this discount rate and they're projecting, okay, we're going to get contributions for the next 100 years and these amounts, is that reasonable? I mean, it's really hard to audit the future, but the GASB is, I guess, asking us to do so. So there's a lot of new procedures on our end as well as your and your actuary's end to deal with this. All right. This slide is really just talking about some of the required supplementary information that needs to be disclosed within cost-sharing pension plans financial statements. Some of this will impact the counties because a lot of it is information you guys are going to need to also disclose. The it's my understanding that INPERS will be providing information for you guys moving forward. All right, GASB statement number 68. So we talked a lot about 67, which is more specific to the Indiana Public Retirement System and what they need to do. Now we have GASB statement number 68, which is what all of the employers need to do. This statement was issued in June of 2012 and is effective for plan periods beginning after June 15th, 2014. So fiscal years ending after June 30, 2015. I believe most of the fiscal years here are going to be your calendar year ends. So December 31st will be the first year that GASB statement number 68 will need to be implemented for all full accrual gap basis reporters. And that's it on that. Some of this stuff is repetitive because the two statements are interrelated, so bear with me on that. But now, for the first time ever, employers are required to recognize pension amounts both on their financial statements as well as disclosed within the notes to those financial statements. Those amounts include the total pension liability, the plan net position, and then with the math you get the net pension liability, which that's the amount that will need to be recorded on someone's financial statements. In a cost-sharing world, which is what INPERS and PERF, the Public Employee Retirement Fund, is, that amount will be allocated to each employer based on a proportionate share calculation, which that will be done at the Indiana Public Retirement System and provided. And that'll also be something that we, as the auditors for them, will be looking at. In addition to that liability, you also need the income statement impact, which would be the pension expense, and then there are certain gains and losses that need to be deferred per the GASB's infinite wisdom, deferred inflows and outflows of resources.
This slide is probably the most important, even though it's just a couple items on here. For the first time ever, all of the individual participating employers, that is those that report on a GAAP basis, will be reporting this net pension liability within their financial statements. So, you know, if you thought, you know, things were tough before, now you're going to be allocated another, you know, big number, which is going to be a big negative number. And, you know, a lot of organizations that are running at a break even, or, you know, maybe have a small surplus or small deficit, you're going to have a huge deficit now, because this number is going to come in and it's going to whack your net position for those of you that report on a GAAP basis.
That's correct. I do have some good news. Joe and I often default to the Illinois situations. Luckily here, I believe PERF is roughly 90%. I don't remember the specific number, but it's in the 90s or right there. So the number's not quite as big here because the plan has been funded better historically. So that is somewhat good news for you as the employers. Some of this stuff I've already discussed. As we said before, the total pension liability is measured by the plan actuary. It takes into account all of the members of that plan. So in the PERF case, anyone who works within the state of Indiana for a governmental entity that is a member of PERF is subject to this valuation, whether they work currently, they've ever worked at any point in time, or that they are now a retiree benefiting from and being paid out by INPERS. The plan is responsible for the actuarial valuation and the applicable assumptions. The employers are not responsible, and that's really the reason that INPERS exists, to manage that for you. Now we're going to get a little bit into the timing of and how it all works with the valuation and what and when needs to be recorded. There's a lot of small issues relating to timing because INPERS has a June 30 year end, while a lot of employers of INPERS have December 31 year ends. The GASB has kind of, knowing that that type of situation could exist, they have allowed for certain things relating to that. As far as INPERS goes and the perf plan used, the first measurement was done as of June 30, 2014, using census information as of June 30, 2013. That information was the information that was tested last year when we did the testing of INPERS for the first time, and that information is rolled. The measurement is done as of a point in time, June 30, 2013, and then it's rolled forward to account for any significant changes. So if an employer drops out of the plan during 14 or a new employer joins the plan, that needs to be accounted for, and it was by the actuary and INPERS using different methods depending on the situation. The standard specifically states that the data used can be no older than 30 months plus 1 day prior to the fiscal year end. Ultimately, I think what will end up being for any June reporters is 24 months plus 1 day. Any December, this would be a situation where we would hit the 30 months. All right, so it's, again, a little bit of more details going on the timing. A lot of this is information that is not necessarily applicable to you, but what is important is to figure out exactly when the measurement date you will be implementing is. The measurement date, once it's selected, cannot be changed. It needs to stay, and there are some specific rules that are slightly different than census data timing. We've prepared a couple of examples. So the measurement date of a total pension liability must be as of a date no earlier than the employer's prior fiscal year end. So here, if we are a 12/31 year end and you're implementing GASB 68 as of December 31st, 2015, so this December, you have to use a measurement date that is in between December 31/14 and December 31/15. However, you're kind of stuck with what INPERS plan year end is because their year end is June 30, 2015. So you have to use a date in between, and you're pretty much stuck. Then your measurement date has to be June 30, 2015. You don't have any other options. I did include a couple of examples. I'm going to gloss over this one slightly. This is for the teachers who are members of INPERS. The teachers' plans, I'm guessing a lot of school districts here throughout the state of Indiana are going to be June year ends, just on the nature of the school year. Due to that fact, a school district's going to have a June 30, 15 year end and a June 30, 14 year end, which corresponds with INPERS plan year end. So they theoretically could use a measurement date as of a year before if they want, or they can wait until the June 30, 15 information is available and use that information. It's recommended that they use the year-old information. Basically, otherwise you'd have to wait for INPERS audit to be totally complete and then the allocation also complete. So it's recommended to use the June 30, 14 information, but it's ultimately up to the employers. INPERS can't tell any of you guys what to do. They're just suggesting what they believe and we would concur with. Here's just a visual of the same thing I just discussed. Another little wrinkle into this is if you do use a date that is as of the year before or not the same as your year end, there is a special deferral that needs to be taken into account. Any employer contributions paid to INPERS between the period of the measurement date and your year end needs to be deferred. So, example, if your year end is December, which I'll just move to the next example. So this example is exactly what I've kind of talked about already. If you are a December 31 year end. This December 2015, you're kind of stuck using a measurement date of June 30, 2015. There is no other option. And just to go on the specifics, so you're going to be picking up the details of the actuarial valuation as of the measurement date. That measurement date would be June 30, 2015. So any contributions paid from the county to INPERS as of between the dates July 1 and December 31 would be deferred on the financial statements of a GAAP basis reporter.
So there's a lot of decisions that need to be made in the year of implementation in terms of what dates to use and what measurement periods. And once those decisions are made, you'll use those same dates consistently going forward. But it started at the plan level where there was, quite a bit of discussion and debate over what information to use, and that's why it was decided to use information from a year prior, because number one, the GASB allowed it, and secondly, it just made it easier to accumulate the information and do whatever allocations needed to be done earlier on in the year using prior year information.
All right. One thing I talked about briefly was the GASB's deciding to throw in these different gains and losses on the valuation during the year. So every year when the actuary is doing their valuation, there are certain assumptions used based on mortality, pay rates, retirements, turnover, stuff like that, which they're estimating what it's going to be, and then at the end of the year they compare what their estimate was to what actually occurred, and the difference would be deferred, so smoothed out over time in the recognition. Certain deferrals are then amortized over a period of time and recognized in pension expense. That amortization is dependent on the type of deferral. For pretty much all deferrals not related to investments, it's based on what's called the average remaining service life of the plan as a whole, which is something that INPERS will be providing and the actuaries have calculated based on the census data. For investments, every year the plan is projecting to get a long-term expected rate of return on investments. That return is compared to what they actually received, and the difference is deferred over a 5-year fixed period. As I was talking about some of the amortization of the deferrals, I went into some of those details. As we move forward, every year there's going to be what's basically a new layer. So you don't recognize the entire thing. This year it was measured, now it's deferred over 5 years. Next year it's going to be measured again, and then it's deferred over 5 years. So it's going to keep building on top of each other, and it's going to turn into an Excel nightmare. Here, I do have a little bit of an example. Actually, I don't know where that is, so I'll just wait. In addition to the deferrals I talked about relating to actual versus expected experience, there are some other deferrals that are specific that need to be made. So in the first year of implementation, INPERS is estimating, okay, the proportionate share for every employer is going to be based on salaries and wages reported to INPERS. So every employer is going to get their percentage of the total based on their amount of salaries. Next year, they're going to do it again. But that number is going to shift. It's never going to stay exactly the same. There's going to be a slight difference. Wages could go up at one employer and down at another, which would change their proportionate share. So due to that change, that difference needs to be deferred. In addition to that, and this is something I brought up briefly, any contributions made after the measurement date also need to be deferred.
These concepts of deferred inflows and deferred outflows, initially sound fairly complicated, but they're really fairly simple once you start doing the math. And once you do the math and you realize your proportionate share has changed, you have to do something with that number. That becomes a deferred inflow or a deferred outflow. Once you do the math on the investments and the actual earnings are different than what the actuary projected, you have to do something with that number. That then becomes a deferred inflow or deferred outflow. So I think it's a lot easier once you actually start working with the numbers and you calculate these differences, and then I think it becomes pretty obvious what the deferred inflows and outflows are.
I agree. Also, good news for you guys, INPERS is going to be the ones reporting all this information to you. So they'll be tracking it and providing it. All right. To go along with the reporting and recording of the pension amounts in the financial statements of the employers, there's also some required disclosures. I've listed out several of them. I'm not going to go through every single one, but for the most part, you need to disclose, okay, your employees are members of which plan, which is, in this case, I think a lot of the people here today are going to be members of PERF. That is administered by the Indiana Public Retirement System, or INPERS as we've started calling it. A brief description of the types of benefits that the employees get, the number of employees covered by the plan, and in this case, the pension plan does issue standalone financial statements, so you would just reference to where those financial statements could be obtained. In addition to that, you are required to disclose some details relating to the actuarial calculation and including the assumptions used. In a cost-sharing world, you really don't have any control of those assumptions, but you are required to disclose them. INPERS is the ones actually managing them, and they should be available within both INPERS financial statements as well as INPERS particular plans actuarial valuation, which I believe is both posted on INPERS website. Also, the discount rate, some of the items I know we talked in detail about what the discount rate is. There's no need to disclose the actual calculation. You just disclose what it ends up being, and if you do end up running out of money and use a lower rate, you disclose for how long of a period you use that lower rate. And then ultimately, one of the main impacts of this is what's called sensitivity analysis. So this is a new disclosure relating to the discount rate, which kind of shows the impact of this rate. The actuaries should be providing it, but what it's going to show is in the middle you're going to have the actual discount rate used to measure the pension liability. And then you're going to show a plus 1% and a minus 1% to show exactly how much that liability would change depending on if the discount rate changed. I know in Illinois, a lot of us are focusing on the going down 1% and how much bigger that liability gets and how feasible is it for that liability to actually be paid off. It's good information that was never available before, which I think really kind of hammers home that this liability is real, it's going to be recorded, and it's important to make sure that it's looked at and funded appropriately. Here's the slide I was looking for a few minutes ago. When I was talking about the layers of the amortization, this is just a brief example. As you see, there's 5 different years of differences for investment returns. And then over the 5 years, you just divide by 5 and recognize each piece each year. It can either be an inflow or an outflow. And over time, this schedule is going to become 5 years. Right now, it's only the 1. And it needs to be tracked, maintained, and reported. In addition to disclosures in the notes to gap basis reporters, you also are required to disclose certain supplementary information. 10-year schedules going forward for the most part regarding certain information on the net pension liability, components of that liability, etc.
And these schedules are really there to show the progress towards satisfying that liability. You know, historically, what have the investment returns been, and is this liability going up or is it going down?
We're going to gloss over that. I'm going to get more. We talked a lot about the background. Now I'm going to we're going to start discussing how is this impacting everyone here. So the AICPA State and Local Government Expert Panel issued a series of white papers, I think in February of 2014, to address both audit concerns and some accounting concerns relating to the impact of GASB Statement Number 67 and 68 on cost-sharing employers. One of those white papers was based specifically on reporting, which that goes into, okay, the cost-sharing plan, how does each employer know what their share is? The AICPA has recommended that the plan, in this case INPERS, provide a schedule of allocation and basically they calculate a proportionate share based on a factor, which could be something related to how money is paid into the plan. So since for PERF, all contributions made to INPERS for PERF are based on salaries and wages for the most part, that they're going to be using salaries and wages to allocate the liability. In addition to that, they're going to show, okay, we have this many employers in the plan, I think it's over 1,000. Of those employers, they're going to show this percentage goes to this employer, and therefore they pick up this amount of the total net pension liability, deferred inflow, deferred outflow, and pension expense as applicable.
The issue here, when the GASB put together Statements 67 and 68, they came up with some really good ideas about computing this net pension liability and getting it on the books of the various employers. So conceptually, it all made a lot of sense. But practically, how to apply these standards and how to make it work really wasn't addressed by the GASB. They just said, here's the new standards, try and comply with them. So the AICPA Governmental Expert Panel came along and issued these white papers that Bill's talking about. And really, that's the only guidance that's out there in terms of how to implement these standards. And it set forth some recommended statements that needed to be issued by pension systems in order for all of the individual employers to comply with the new standards. And some of this reporting, you'll see it eventually coming from the pension system, where it takes the pension amounts and allocates it, and then it actually includes an auditor's report, auditor's opinion on all of those allocations. So this is something new that came out of the AICPA white papers. And all of this is supposed to be consolidated into the new governmental audit guide that's due out within the next couple, 2 or 3 months. So I'm sure you're all chomping at the bit waiting for that to come out. So once it does, all of this will be formalized in the audit guide.
Correct. The second white paper, which has a significant impact on everyone here, is related to census data testing. So this white paper discussed, okay, something that's really never been done before is, especially for active employees, the payroll and specific pension or census information are the auditors of the plan going out to the source to truly test that the payroll reported to the plan is correct. This is something that's changed. It's something that we started here in Indiana last year. Some of you may have been contacted and tested last year. Some of you may not. I can assure you that over time, everyone will be contacted and everyone will be tested. And we're going to go into the details of that after a break, but hopefully that'll be a little bit more exciting, since I think a lot of that is more applicable to everyone's everyday lives. We kind of already talked about this, just to kind of get into it real quick. As Joe stated, the first white paper based on reporting provides recommendations for a schedule of allocations and schedule of pension amounts based on that allocation. And then us, as McGladrey being the plan auditor, we will audit and give an opinion on that schedule. And then INPERS will provide that information to all of you to start picking up these amounts and appropriately reporting and disclosing these amounts. And now we get to census data testing, which, as I stated, was going to be kind of the second half of our presentation, but I think it's time at this point for a break.
Ready for a break.
Thank you, everyone, so far for your attentiveness.
Here's the type of things that employers are going to need to be aware of. Here's the information that's going to be looked upon. And a number of employers have been selected to be tested and have been visited either last year, or some will be visited this year. But over the course of the next several years, everyone will have the opportunity to be visited by auditors from the system, whether it's us or whether it's the internal audit department of the system. So if you haven't been visited yet, you're lucky so far, but eventually it'll be there. So we're gonna get started. I'll turn it back over to Bill.
Thanks, Joe. So I hope everyone had a nice break. Hopefully now, I know that first session was a lot of information and a lot of it was probably pretty dry and tough to listen to. I hope we made it as exciting as possible. Now what we're going to talk about is a little bit more specific to you guys on a daily basis, especially going forward. This is our second year as the auditor of INPERS. As part of that audit, we are engaged to perform testing on census data relative to each pension plan administered by INPERS. Specific here, the PERF plan, the Public Employee Retirement Fund, which a lot of the county employees are members of, we need to be testing census data that goes into the actuarial evaluation to ensure that it's correct. This year, the period to be tested for the valuation is going to be June 30, 2014 information. So fiscal year for INPERS purposes, June 30, 2014 is what's being reported to the actuary to measure the liability for their June 30, 15 financial statements. As Joe mentioned, a lot of employers were visited last year for the first time. I think we learned a lot, and hopefully they learned a lot from those visits. But moving forward, a new year means new employers, and going forward, all employers will likely be subject to testing in future periods. As far as the data goes, retirees and inactive employees, for the most part, our testing will be centered at INPERS itself. We're not expecting that an employer, someone who worked at an employer 10 years ago, you guys don't need to maintain information. We're not asking for that stuff from you. That'll be dealt with at INPERS. But what we need to test at your level is the active employees. Our objective in this testing is to verify that the plan has the right information to base the pension calculation. The actuaries use this information to calculate the total pension liability, as well as all the assumptions we talked about earlier. But this data is truly what represents the liability, as this data is all the beneficiaries of the plan, or future beneficiaries, I should say. All right, To test that data, here is what we are going to be looking for. We will provide a sample of employees. That sample will be based initially on information that we get from the plan. So MPERS has a listing of everyone who is a member of PERF for the year and also their status, active, inactive, retired, and we will be testing each population separately. The active piece is very important to you guys. We are going to pick a sample of active employees and say, okay, we've selected you for testing this year, you as the employer. Here's a listing of employees that we need to trace applicable pension data back to source documents. I've listed out several of the items here: hire date, years of service, age, eligibility, gender, birth date, and employee status. We will provide this sample in a spreadsheet format, so each of you employers, when we contact you, will know exactly what we're looking for. We will need access to original personnel files to see source documents. Those documents can be either if you maintain a copy of a driver's license or a state ID or something like that that has a lot of this information, contract information for employment, union agreements, stuff like that. In addition to that, any type of an application or some sort of form that is filled out by the employee and signed, if a copy of a driver's license is not maintained, anything that is signed by the employee is another item that we can utilize to verify information. INPERS this year has given us employee ID numbers provided by INPERS. They call these PIDs. That was the only information we had last year when we contacted employers. And based on some of the feedback we got, that is not necessarily something that you guys are tracking or aware of. So when we showed up and said, hey, we need information on these 12 PIDs, we got a lot of, what does that mean? And that's fair. I think INPERS was thinking that in creating unique IDs for everyone, that you guys would use them, and ultimately I think that that was maybe a big assumption. So this year we have more information. We have PIDs, we will also have names, and we also have the last four of the Social Security number for each individual. So we should be able to make sure we can tie in everyone we pick at the INPERS level back to source documents at the employer level, specifically the payroll reports. All right, so we talked a lot about the census information. Now I want to get into the actual payroll information. So this year, when we make our visits, we're going to be testing earnings from July 1, 13 through June 30, 14. Those amounts are the amounts that are reported to the actuary by INPERS, so that's the amount that we need to test. We do understand that a lot of the employers do not have the same year end, and generating these reports, this information is not necessarily super easy to do because of that. There's going to be a lot of working with the payroll people and the payroll systems to generate the information we need to show paid amounts from this period, not necessarily the employer year end, which could be different. We want to verify the actual amounts that were reported to the pension plan. In addition to that, we also want to trace back, okay, the annual salary amount of that employee. So a lot of times you're going to have an employee who their contracted salary or rate is this, but they actually ended up making this depending on several different factors. It may be the same, it may not, you never know. In addition to that, like I was saying before, copies of salary approval. So if it's a rate, some sort of approval document for that rate, or if it's a contract, a copy of that contract that we can look at and just verify the amount. If it's a collective bargaining agreement, a copy of the collective bargaining agreement, and then information to show where in the bargaining agreement the employee falls based on years of service, etc. We will need information on a pay period detail for everyone that we select for testing. In addition to that, we also need everyone not selected for testing relating to in total. We need a payroll report that lists out everyone so we can tie that back into your records to make sure that we're subjecting everyone to test. In addition to the people who are INPERS members, we want to make sure that someone's not missing. We want to make sure that at the employer level, an employee who should be in INPERS, but maybe for whatever reason was not, or was never reported to INPERS and therefore not getting the proper benefits, we want to make sure that we catch that as well. So in addition to the sample that we test based on the INPERS information, we also are going to request information for all non-member employees and a listing so we can pick a sample of them just to verify that their position within the employer is not covered by any of INPERS plans. All right, a key cog in what I was just discussing is we need to be able to reconcile payroll records back to the employer ledger or financial statements. A big accounting term is the general ledger. Some employers last year, when we started using that term, kind of looked at us like we were crazy. They didn't really know what we were talking about, and I can understand that. Sometimes as accountants, we start using our own words that we make up and think everyone understands, but sometimes they do, sometimes they don't. Every employer is different. Ultimately, we want all the information for payroll for a period. We want to make sure we have everything that was paid by the employer to all of their employees for a period of time. And we want to be able to reconcile the report that we get back to what was reported to INPERS, and then also back to the totals that were reported within the financial statements of each of you. So I guess a quick example, for a county, my belief is a lot of you guys are going to be members of PERF. I was informed today that a lot of you do not have anyone who are in 1977's police and fire. The county sheriffs have a separate plan that are not covered by INPERS. So those will still be people that we want to potentially look at, basically just to verify that they shouldn't be in INPERS. So when we say we want to be able to get a total listing of all employees and all pay for a period, that's kind of what we mean. We want to just see, okay, this particular county sheriff is not in INPERS, and he is a county sheriff, so okay, we're happy. That's really all we need. We just need to verify that their position is not an INPERS covered position. And the reconciliation really is key with that, because that's really how we've determined that we have everyone subject to test and that no one is left out. I guess another key item in this, and I know I've kind of brought it up several times, year-end dates are different. I know INPERS is a June 30, as I've said, and a lot of the employers are not. It's not ideal for that to be the case, due to the fact the differing time. I know one big thing that a lot of employers try to talk to us about is, well, can't we just give you the person's W-2 or W-4 or whatever information feasible for pay for a period of time, and wouldn't that make everyone's life easier so we can just use data that we already provide to somebody else? And I would agree, it definitely would. Unfortunately, it just doesn't work that way every time. So it's something that we would love to try to do, but ultimately it hasn't worked out when we tried it in the past. So especially for differing year ends, anyone who's a 1231, what we really kind of need to do is drill into the system and show, okay, for the 6 months here they made this, for the 6 months here they made this. We'll work with you. Any questions you have, you can feel free to contact us. We will provide contact information to all of the employers we're subject to the test. Both Joe and I's contacts are in there, as well as the individuals who are making the visits, as well as our key people here in Indiana, Jessica Klein, who helped out last year with a lot of it, and Scott Williams, who's doing a lot of the key coordinating this year, are also available. And all that information we will provide to the SBOA to get out to you. I guess ultimately, I'm just curious. So we're here today talking to a lot of you. Have any of you been contacted by us to be tested this year? 1, 2, 3, 4, 5, 6. All right. I know we started our visits this week. Was anyone scheduled this week? Tomorrow. Have fun. Did you participate in the webcast? Yes? Was that helpful? I know a lot of this is going to be similar information. I know. Yeah. Gotcha.
Yeah, unfortunately, we're bound by the information that the pension system reports to the actuaries. Right, your payroll system, being on a different fiscal year, produces information that's a little bit different. So, but the overarching principle here, and the reason for this reconciliation and all this discussion is there has to be some evidence that all employees were considered somehow, and that people are, because all we have at the pension system is what's been reported to us. But we have to give assurance that all the other employees that are out there are either picked up in the the sheriff's system, or whatever pension system they're involved with. So we have to reconcile to all payroll, and you're going to feel like you're getting audited again. But appreciate the help, and hopefully after everybody gets used to this, then it becomes a little bit more routine in the future.
Yeah, another item, I know, and we have some of the people from INPERS here today, but in addition to us as the auditor for INPERS making visits, there will be people from INPERS going forward also making visits. We will attempt to not hit the same employer by both of us at the same year. It could happen, you never know. But for the most part, we'll try to make it as painless for you guys as possible. But I know that they have just been getting started on their visits as well. And for the most part, my understanding is a lot of what they're asking for is going to be very much the same as what we're asking for. And I guess we apologize in advance, but we didn't write the rules. We're just trying to implement them. All right, trying to get back into the presentation. This slide is just a sample payroll reconciliation. There's a lot of information on here that could be applicable to you, as well as information that is completely not applicable. One thing that we learned based on our visits last year, this potentially made it harder for some employers and not easier. We tried to list out things based on our experience with other plans in other states, things that could be applicable, but what really has kind of showed up was every employer is kind of different. Every employer has their own payroll system. Every employer tracks stuff their own way. So to do this, it really does take a team effort between the employer as well as us. We do invite all questions. We would like to make this as easy as possible. We're not trying to make your lives miserable. We appreciate all the help we're getting, but we would also like to make sure that you're aware that we are willing to help and work with you, and we should be able to answer all questions. It might take a minute here or there, so the sooner you get back to us, the easier it is. And if the reconciliation's done before we show up at your door, then the process really is pretty simple. We'll be in, we'll look at some files, we'll look at some payroll information, and we'll be out. For the most part, they're less than a day most of the time. Here's a listing of potential reconciling items. I'm not going to go over this because, like I said, every employer is different. Every employer reports differently. Every employer reports differently to IMPERS. There's so many different nuances that some of these might actually apply, but a lot of the times they don't. So this is something that I've already discussed, but we want to kind of try to harp on it. And as Joe kind of pointed out, we really need to be sure we're testing everyone. So this means we're also going to look at people who are non-IMPERS related. So people who are, like I said, the county sheriff example. What we're going to do there is we're going to look at eligibility to test that they are properly excluded from the IMPERS plan based on basically their job description, their posting, whatever it is that we can get a handle of to ensure that it makes sense that they're not in the plan. We will not necessarily need to get all the information we need for someone who is in the plan. If they're properly excluded, we will not be testing all their census information. It's not applicable to us. We will also not necessarily be testing their payroll. We just want to look at the employee. The only time we would really drill in and say, oh, well, this person should have been included, if that's the case, then we would need to test all of their information, or at least gather it to bring back to IMPERS to say, hey, we have someone who's missing and needs to be added. All right, as far as what you guys can expect from us, we will provide, in the year you get selected for testing, we will provide a sample of employees to be tested in advance of the visit. We will provide the total annual payroll amount that was reported to IMPERS, so the amount that needs to be reconciled to. What we're asking for from you is we need all supporting documentation for pay by each employee selected to be made available for us in advance of our visit to make it easier on everyone involved. And we will need access to personnel files to trace census data to underlying records. Another key item in this, a lot of this information is sensitive personal information. Just to give everyone assurance, we are aware of that. Our information is encrypted on our laptops when we're making these visits. None of this information is maintained. We're testing the information provided by IMPERS back to the information held at the employer. We should not be making copies of anything. I'm not aware that we will be. The only time anything like that could occur would be if we have an exception or anything like that. But in that case, that would be communicated with you at the time. But we do not plan on taking any payroll information or any personal information with us by any means. The plan is to come out to you, look at it, and leave. And hopefully that's all that ever happens. I guess a key, when making these visits, what we learned last year a lot is we really need the employer as a whole to be involved. We need to be testing census information, which could be more related to HR. We need to be testing payroll, which could be related to payroll. But ultimately, we may need, if we find issues, we need someone in a level of authority to be there to maybe either provide explanations or be there to listen to our issues so that there's no big surprise when IMPERS come back and says, hey, McGladrey did this audit and found these issues. We need to get these corrected. We need to do something. We need to come out and test more. Stuff like that. We don't want any surprises. So ultimately, communication is key, and communication at all levels at the employers as well as from us and INPERS really needs to be 100%. What we need from the employers, we need help from all of you. We're going to be making these visits every year going forward, and when I say we, I mean the auditors of INPERS, INPERS internal audit, or INPERS employees themselves are going to be making sure this information is correct. If everyone works together and communication is good, we believe that it should be relatively easy. We can be in and out in a couple of hours at times, depending on the size. And hopefully, basically we contact you, you deal with us for a few hours a couple of times, and hopefully you don't hear from us again for a long time. This year, each of the selected employers for 15 have already been contacted via email. We've started our visits this week. We've already kind of talked about one particular person we'll see tomorrow, and several others later in the year. We need all selected employers to obtain the backup documentation that we're requesting, hopefully in advance of our visit. The good news is if you gather it in advance, we'll be in and out a lot sooner, and you won't have to deal with us anymore, at least for a little while. And we really need the reconciliation for payroll that we went over a little bit to be done, to make sure that we touch everyone and make sure that we have the information available and that INPERS information was proper, so we can be assured that that total liability that eventually ends up back on your books is correct. Do I have that in there twice? I guess at this time, is there any questions?
One thing that we haven't covered in the slides that I wanted to just touch upon a little bit is anyone who has a single employer pension plan, because that pension plan, if that's part of your reporting entity, it needs to follow all of the requirements of GASB 67, but the employer reporting entity follows statement number 68. So you could have a situation where you're reporting two different sets of information within the same set of financial statements. So if anybody is involved in a situation like that, be sure to check with, check with your auditors. You can check with us because the reporting is going to be extremely complex until both standards are implemented. You know, with the staggered implementation date for the pension part of your report, you're implementing that before, a year before, you are the disclosures for the reporting entity as a whole. So that's kind of a nuance. It's kind of a unusual relationship, but I think you all need to be aware of it. This concludes our presentation. If anybody has any questions or concerns or wants to chat for a while, we'll hang around for a little bit. But it's, it's a big undertaking. It's a big project. I've been doing this for a long time, and this is probably one of the most sweeping changes that I've seen in the profession, certainly as it relates to pensions, but the complexities associated with this are even a lot more complex than GASB 34 when that came about 10 years ago. So with that, thank you all. Appreciate it, and we'll turn it over.
Real quick.